Right now, at this exact moment, the commercial real estate system is printing a number that forces the entire credit market to flinch. Office CMBS delinquency is 12.34%. Total CMBS delinquency is 7.47% in January 2026. That is not a normal cycle. That is the system admitting in public that one of its biggest collateral pools is failing in real time. And there is a second number hiding behind the first one. Over $40.1 billion of CMBS loans are sitting in special servicing right now. That is not paperwork. That is the foreclosure funnel filling up. That is the collapse engine warming to operating temperature. These numbers do not stay inside a bond. They travel. They hit bank capital. They hit insurance balance sheets. They hit pension assumptions. They hit municipal budgets. They hit your credit line, your mortgage rate, and the loan officer who suddenly stops returning calls. Because CMBS is not a niche product. It is the warehouse where commercial real estate promises get sliced, rated, and sold as safety. When one layer breaks, the layers above it do not stay clean. They get repriced, they get downgraded, and they get dumped into the same market at the same time. The trap is that the system can look calm while it breaks. Checks clear, ATMs work, buildings still stand, but the bonds under them are changing hands at new prices, and those prices decide who gets credit next. This is not speculation. This is not fear. This is pattern recognition, and the pattern has repeated for generations without a single exception. In this story, foundation and trust turns into overextension. Overextension turns into the crack. The crack turns into transfer and reset. You see it in Japan when real estate becomes collateral for everything. You see it in 2007 and 2008 when CMBS rollover dies and downgrades cascade. You see it in Europe when property loans trap local banks and local governments together. And you see it now, on February 11, 2026, when the delinquency numbers finally cross the line the market was pretending did not exist. Here is the mechanism. Watch the sequence because this is how credit systems rise and fall. There are 4 stages. Each one is predictable. Each one is measurable. Each one has happened before. Stage 2 is overextension. Assets grow longer. Funding stays short. Promises multiply faster than cash. Risk hides inside safe labels and familiar ratings. And the system rewards the people who can grow fastest, not the people who can survive stress. Stage 3 is the crack. A small failure reprices the entire field. Funding costs jump, liquidity vanishes, forced sales begin. The system discovers that price is not a number, it is a buyer, and the buyer can disappear overnight. Stage 4 is transfer and reset. Paper claims get delayed or discounted. Assets change hands. Credit tightens. A new system emerges on the wreckage, with new winners holding the same buildings at a lower basis, and writing new rules everyone swears they will follow forever. This pattern does not care about good intentions. It does not care about speeches. It does not care about regulation that arrives after the loan is already made. It only cares about one thing: short-term money funding long-term promises, and long-term assets priced as if the short-term never changes. The first case is Japan, the late 1980s into the late 1990s, when property becomes a national religion and banks treat land like cash. Stage 1 is foundation and trust. After the Plaza Accord in September 1985, Japan rides a wave of growth, export strength, and policy support. Credit feels infinite. Land is treated as the safest asset on earth. In Tokyo, businesses borrow against land, then buy more land, then borrow again. And the balance sheet looks stronger every time because the collateral price keeps rising. The confidence becomes cultural. Real estate is not just an investment. It is status, security, and national destiny. Banks expand lending because regulators are calm, borrowers are eager, and every appraisal tells the same story. The last transaction is higher than the one before it. Stage 2 is overextension. Banks compete to lend. Corporations turn real estate into their collateral engine. A loan is not judged by durable cash flow, it is judged by the appraisal. Promises stack on promises, and the risk hides inside a single belief. Land does not fall. Inside the bubble, the mechanics are simple. If the collateral rises 10%, the borrower can refinance, pull cash, and buy again. That cash is not income, it is borrowed confidence. The entire system becomes a machine that converts higher prices into more credit, and more credit into higher prices. Stage 3 arrives on schedule, on a calendar date you can point to. On December 29, 1989, the Nikkei peaks near 39,000, and then the illusion begins to break. Buyers hesitate. Volume thins. The collateral machine needs continuous price discovery, and now the market discovers something brutal. Without a buyer, the appraisal is fiction. The crack spreads through quiet actions. Banks tighten terms. Borrowers roll loans with difficulty. Properties that were worth anything on paper cannot be sold at that price in cash. Deals fall apart after weeks of negotiation because the lender demands more equity, and the borrower does not have it. The system tries to delay recognition. Losses stay hidden in restructuring, extensions, and accounting patience. But the pattern does not care about patience. It only cares about math. When the collateral stops rising, leverage becomes a trap. By the autumn of 1997, the delay ends and failure becomes visible. On November 3, 1997, Sanyo Securities collapses, and the money market learns that a promise can break in a single day. On November 17, 1997, Hokkaido Takushoku Bank collapses, and the country watches a major institution admit what everyone already knows: the collateral is gone. On November 24, 1997, Yamaichi Securities announces it is shutting down, and confidence drains out of the room. Now the cascade accelerates. Funding gets scarce. Lenders stop pretending. Borrowers who lived on rollover hit the wall, and the wall does not negotiate. On October 23, 1998, the government nationalizes Long-Term Credit Bank of Japan. On December 13, 1998, Nippon Credit Bank is nationalized as well. The chain is not random, it is the pattern. Overextended property collateral turns into bank losses, and bank losses turn into a credit freeze. Stage 4 is transfer and reset. Bad loans get carved out, capital gets injected. Years pass. Assets change hands quietly to stronger balance sheets. The old owners keep the debt, the new owners buy the buildings. The timeline varies, the sequence does not. Every single time, without exception. The second case is the United States, 2003 through 2012, when CMBS becomes a factory, and the factory runs until it runs out of refinance. Stage 1 is foundation and trust. After the early 2000s recession, rates sit low and capital looks for yield. Commercial real estate feels stable, occupancy looks steady. Wall Street builds a pipeline that turns office towers, hotels, malls, and apartment complexes into bonds. Ratings bless the top slices. Investors buy them as if they are cash. The structure feels like science. A pool of loans goes in, a waterfall of payments comes out. Senior tranches get paid first. Junior tranches take losses first. The story is that diversification makes the whole thing safe. Stage 2 is overextension. Underwriting stretches. Interest-only loans become normal. Pro forma rents become reality in the spreadsheet. Appraisals rise because cap rates fall, and cap rates fall because money is cheap and the bond market is hungry. Issuance grows until the machine produces over $200 billion of CMBS in a single year. Inside the factory, incentives do the work. Originators get paid to close. Rating models assume liquidity exists. Investors chase yield and accept structures they do not control. The risk hides inside the timeline. Many of these loans are written with a single exit: refinance at a higher value. Stage 3 arrives on schedule, on a calendar date you can point to. On August 9, 2007, a major European bank freezes funds, and the global funding market feels the temperature drop. Credit spreads widen. Buyers demand more yield. The CMBS factory depends on confidence and constant rollover, and now the rollover is no longer automatic. This is the key moment. A loan can be current and still be doomed. It can pay every month and still fail at maturity because the refinance market is gone. That is how Stage 3 begins. Not with default, but with the disappearance of the exit, the crack turns into a cascade. New CMBS issuance slows, then stalls. Conduit lenders pull back, warehouses tighten. Loans that were written to refinance easily now face a market that does not want to lend at yesterday's price. The bid vanishes first in the riskier tranches, then in the supposedly safe ones. In March 2008, Bear Stearns collapses into a rescue sale, and the system learns that liquidity is not guaranteed. On July 11, 2008, IndyMac Bank fails, and depositors line up, because the public senses the same thing professionals sense. Credit is tightening. On September 15, 2008, Lehman Brothers fails, and the freeze becomes official. Now the mechanics do what they always do. Properties that need refinance cannot get it. Defaults rise. Loans transfer to special servicing. Special servicers are not in the business of hope. They are in the business of recoveries. A loan goes from a master servicer to a special servicer because something breaks. A payment is missed. A covenant is breached. A maturity cannot be met. Then the file becomes a process. Cash management tightens. Reserves get trapped. The borrower's flexibility collapses. And the deal stops being about the building and becomes about the bond. Downgrades follow the cash flows. Tranches that were rated safe get cut when expected losses rise and when interest shortfalls appear. Investors sell what they can, and the stuff they cannot sell becomes trapped on balance sheets. Regional banks holding commercial real estate exposure get hit twice. Their borrowers struggle, and their bond portfolios reprice. Stage 3 becomes a loss spiral. Markdowns hit capital. Capital pressure tightens credit. Tightened credit creates more defaults. More defaults push more loans into special servicing. More special servicing produces more forced sales. Forced sales create lower comps. Lower comps force more markdowns. By April 16, 2009, General Growth Properties files for bankruptcy, one of the largest real estate failures in American history at the time, and the market gets a clear message. Even iconic assets cannot refinance in a frozen market. Delinquency climbs, special servicing swells. The crack becomes the environment. Stage 4 is transfer and reset. On November 25, 2008, the Federal Reserve announces a program to restart asset-backed lending, and the system gets emergency oxygen. Years later, new money buys distressed buildings at lower prices. Old equity is wiped. Debt is restructured or written down. The market resets with new cap rates, new underwriting, and new owners. The pattern is complete. Check. Verified. Undeniable. The third case is Spain, 2001 through 2013, when property finance traps local banks and local budgets together. Stage 1 is foundation and trust. Spain enters the euro era and interest rates fall. Credit becomes cheap. Construction becomes a national growth engine. Local governments love it because development fees and property taxes rise. Banks and cajas expand branches and extend loans as if demand is permanent. The confidence feels engineered. The euro feels like a guarantee. Funding comes in from across Europe because everyone believes the same thing. A member of the monetary union is stable by definition. Stage 2 is overextension. Developers borrow to buy land. They borrow again to build. Banks treat rising prices as proof of safety. Loans get extended based on collateral appreciation, not resilient cash flow. The country builds faster than the population can absorb. The risk hides inside the same sentence everyone repeats. Integration means safety. Then the global cycle turns. Construction slows. Buyers vanish. Loans that only work in a rising market stop working, and the system discovers the same truth Japan discovered. Collateral is not liquidity. Stage 3 arrives on schedule, on a calendar date you can point to. On May 9, 2012, Bankia is nationalized, and the illusion snaps in public. The market sees that property losses are not contained. Depositors pay attention. Funding costs jump. The system moves from denial to triage. On June 9, 2012, Spain asks Europe for support to recapitalize its banks, and the country's property problem becomes a continental problem. Confidence collapses through actions. Lending tightens. Developers fail. Properties sit unfinished or empty. Collateral values drop further. Local governments feel it as the tax base shrinks and construction jobs disappear. By September 6, 2012, the European Central Bank announces a backstop framework that changes the psychology of sovereign funding. But the real economy is already in the pattern. Credit is scarce. Budgets are strained. Property values reset lower and stay there for years. Stage 4 is transfer and reset. A bad bank structure absorbs toxic assets. External capital arrives with conditions. Banks merge or disappear. Households and businesses live through austerity while assets move to stronger hands. The timeline varies. The sequence does not. Every single time. Without exception. 3 systems. Nearly 3 decades of modern history. Identical 4-stage cycle. The timeline varied. The sequence did not. Stage 1, Stage 2, Stage 3, Stage 4. Every single time. Now the camera returns to the present, to the commercial real estate system, and to why Stage 3 is happening right now. Stage 1 is foundation and trust. After the financial crisis, rates sit low for years. Money floods into real assets. Cap rates compress. Refinancing becomes routine. Office buildings are treated like durable machines that spit out rent checks forever. Banks lend. Bond investors buy. Everyone behaves as if the next maturity will be easier than the last. Stage 2 is overextension. Promises pile up on the assumption that yesterday's cap rates are permanent. The work from anywhere shift hits demand, but debt stays the same. Then the discount rate rises and the pricing math changes everywhere at once. A building that was valued by a 4% cap rate is not valued the same way when buyers demand a higher return. Refinancing math breaks. Loan proceeds shrink. Equity gaps appear. The refinance wall stands there like a calendar you cannot negotiate with. And the most dangerous part is that this can look quiet for a long time, because many loans keep paying until they hit maturity. Stage 3 is the crack, and it begins with delinquency and servicing, not with a headline bank run. As of February 11, 2026, the market is staring at January 2026 CMBS delinquency at 7.47%. Office CMBS delinquency is 12.34%, the highest level ever recorded for that category. Over $40.1 billion of loans are already in special servicing. These are not theories. These are loans that already crossed the line. Right now, special servicing is the collapse engine most people never see because it lives behind legal documents and monthly remittance reports. A CMBS deal has rules, and the rules are written to protect bondholders, not borrowers. When a loan transfers in, the servicer does not ask what is fair. The servicer asks what is allowed. Right now, the first move is control of cash. Rents that used to hit the borrower's account get redirected. A lockbox appears. A cash sweep begins. Operating expenses get approved. Leasing commissions get questioned. Every dollar becomes part of a waterfall. Right now, the second move is valuation. An updated appraisal comes in. When the appraisal is lower, the deal triggers an appraisal reduction amount. That is not a headline term. That is a mechanical lever that can divert cash away from junior bondholders and signal higher loss expectations to the market. Right now, the third move is time. Special servicers earn fees for work performed and for balances outstanding. The file becomes a conveyor belt of extensions, forbearance agreements, modifications, and then, when patience runs out, liquidation options. Not because the servicer is evil, but because the structure rewards resolution with a number. This is where the liquidation posture matters. In a rising market, extension is easy. In a falling market, extension can be an illusion that delays the inevitable and increases the loss. So the posture shifts. The system chooses liquidation bias because liquidation creates certainty, and certainty is valued when liquidity is scarce. Right now, that bias is colliding with cap rate repricing. When valuations drop, the borrower's refinance options shrink. The building might still collect rent, but it cannot support the old debt at the new rates. The borrower is not refinancing a building. The borrower is refinancing a story the market no longer believes. Right now, maturity defaults spread because the refinance wall is not one day. It is a schedule. Loans written 5 and 7 and 10 years ago come due into a market that demands higher rates and lower leverage. The property has less income. The lender offers less money. The gap becomes immediate distress, and distress becomes delinquency. Right now, delinquency becomes special servicing, and special servicing becomes liquidation comps. Those comps become the new appraisal baseline. The baseline pulls down the next building's valuation, even if that building has a better tenant roster, because the market trades on comparable sales when fear is high. Right now, a single office loan can look healthy until the day it stops being a loan and becomes a bond event. The building still has lights on. The tenants still swipe badges. But the debt has a maturity date, and that date is a cliff. The borrower walks into refinance talks with last cycle numbers. The lender runs today's math. Higher rates mean a lower loan amount. Lower occupancy means lower income. Higher cap rates mean lower value. The gap is immediate, and it is not emotional. It is arithmetic. When the borrower cannot fill the gap, the loan misses a maturity payoff. That is not a slow deterioration. That is an instant transfer event. The file moves into special servicing, and the special servicer does not negotiate with optimism. The special servicer negotiates with deadlines. Cash goes into a lockbox. Excess cash sweeps trigger. Tenant improvement spending is questioned. Leasing plans are rewritten. The borrower loses optionality, and the building's future becomes a choice between paying down debt, bringing in new equity, or handing over the keys. Now the bond structure begins to speak. An appraisal comes in lower, and the appraisal reduction amount activates. Interest that used to flow through the waterfall gets diverted. Junior bonds see shortfalls. Shortfalls get reported. Reported shortfalls become downgrades. Downgrades become forced sales. That is how a property issue becomes a financial system issue. Not because the building collapses, but because the bond that owns the debt must price the loss, and the institutions holding that bond must absorb the hit. This is why the words trapped in the CMBS wipeout are not metaphor. Many banks and insurers cannot sell these bonds without turning paper loss into real loss. So they hold. And while they hold, they protect capital by shrinking new lending. The bond is trapped, and the credit supply around it tightens. Right now, that tightening shows up in the most ordinary places. A local developer gets a renewal offer with a higher rate and a smaller line. A small business loses a revolving facility it used to rely on each quarter. A municipality pays more to finance basic infrastructure. A landlord cannot finance renovations that would attract tenants, so vacancies persist and revenue falls again. Right now, the loop is feeding itself. Delinquency pushes special servicing. Special servicing pushes liquidation pricing. Liquidation pricing pushes valuation marks. Valuation marks push capital pressure. Capital pressure pushes credit contraction. Credit contraction pushes more delinquency. The pattern is absolute. The timeline varies. The sequence does not. Right now, the controlling class is not a neutral referee. The controlling class is often the buyer of the riskier slice of the deal, the slice that eats losses first and therefore earns the right to call the shots. In calm times, that control is invisible. In stress, it becomes the steering wheel. When control sits with a distressed buyer, liquidation is not a tragedy. It is a strategy. A fast resolution can turn a loss into a purchase opportunity. A note sale can move an asset into the hands of the same capital that influenced the workout. That is not a conspiracy. That is incentive design, written into the documents, executed in the workflow. Now connect that to your town. Property tax is not paid by a bond. It is paid by a building's assessed value, and assessments follow transactions. When distressed sales become the comps, the next assessment round drops. Owners appeal. Courts grant reductions. Collections slow. Within one budget cycle, cities face a gap. They freeze hiring. They cut overtime. They delay road projects. They shrink library hours. They trim sanitation routes. They scale back parks maintenance. The civic experience changes, not because someone voted for collapse, but because the tax base is repriced by the same forced sales that are repricing the bonds. At the same time, pension portfolios feel it. Bonds once treated as safe yield behave like risk assets. Private equity marks down. Real estate allocations lag, then drop. Households feel it as smaller raises, smaller budgets, and a more cautious local bank. This is how Stage 3 moves from finance to daily life. The pattern does not stop at the balance sheet. It finishes at the community. Right now, bond investors are forced to recognize that CMBS is not only about default, it is about timing. Losses do not need to be gigantic to be destructive. They need to be simultaneous. A wave of special servicing transfers becomes a wave of distressed sales. Distressed sales become a wave of markdowns. Right now, tranche downgrades are the transmission system. When ratings drop, some holders are forced sellers by mandate. Forced sellers dump into thin markets. Thin markets print ugly prices. Ugly prices become marks. Marks become capital pressure. Right now, those bond losses do not stay in the bond market. Banks and insurers own these instruments, and many of them are not positioned to take a fast markdown without changing behavior. They pull back, they tighten terms, they shorten maturities, they raise spreads, they stop lending to the marginal borrower. Regional credit freezes first, because regional institutions lend to local properties, local developers, local small businesses, and local municipalities. When their balance sheets take hits, they preserve capital by shrinking activity. That shrinkage is not a statement. It is a decision repeated thousands of times, loan by loan. Right now, the tax base starts to wobble. Office values fall. Transaction volume drops. Assessments get appealed. Property tax revenue slows. Cities do not get to refinance their budgets the way a borrower refinances a loan. They cut services. They delay projects. They raise fees. This is how a bond problem becomes a street-level problem within 12 months. These are not isolated facts. They are Stage 3 signals. They are the crack. The pattern is repeating, and it is repeating through the special servicing workflow. Japan shows Stage 3 as collateral illusion breaking, and then bank failures surfacing on a schedule. 2007 and 2008 show Stage 3 as rollover dying, downgrades cascading, and special servicing turning uncertainty into realized loss. Spain shows Stage 3 as property finance trapping local banks and local budgets together until the public sees it. The match is precise. The timing varies. The sequence does not. The pattern is absolute. Stage 4 is coming, and it always looks the same even when the headlines change. In the short term, the system forces resolution. More loans transfer to special servicing. More servicers push note sales, deeds in lieu, and foreclosure timelines. More distressed transactions set new prices that the whole market has to accept. In the medium term, the losses climb into institutions that never thought they were exposed. Bond downgrades hit capital planning. Banks tighten credit. Insurers reprice risk. Private lenders demand higher rates and more equity. Borrowers who were fine on paper discover that paper is not liquidity. In the long term, assets transfer. Strong balance sheets buy buildings at a discount. Weak balance sheets sell into the bid they hate. Cities adapt to a smaller tax base. Some public services shrink. Some local economies reorient. The system resets with new valuations and new ownership, and the people who assumed permanence pay the bill. Stage 4 always looks like relief on the surface and transfer underneath. The headlines say stabilization. The balance sheets say consolidation. The buildings do not vanish. They change hands, quietly, at prices that make the next decade's winners. Every single time, the public pays through tighter credit and weaker services, and the strongest capital pays by buying assets cheaper. The pattern completes. Then the system calls it recovery. What this means for you is straightforward. If your livelihood depends on regional credit, credit tightens. If your local economy depends on downtown office activity, revenue shrinks. If your portfolio is built on the assumption that bonds labeled safe are always liquid, liquidity disappears exactly when you want it most. This is not about panic. It is about preparation. When systems reset, paper promises get delayed, discounted, or restructured. Real claims survive. Local relationships matter. Access to liquidity matters. The pattern has never been broken. Not once, not ever. Let me be very clear about what is happening. Foundation and trust turns into overextension. Overextension turns into the crack. The crack turns into transfer and reset. The commercial real estate credit machine completed stage 1 in the long, low-rate era. Stage 2 builds as valuations rise and leverage expands on the promise of easy refinance. Stage 3 is visible now, in January 2026 delinquency, in office delinquency at 12.34%, and in the special servicing workflow that converts stress into realized loss. Stage 4 follows. It always follows. You can prepare for it or ignore it and hope this time is different. But remember, this time is never different. The pattern is absolute. Japan ignores it and lives through a lost decade of balance sheet repair. 2008 ignores it and watches safe tranches get downgraded while credit disappears. Spain ignores it and watches property losses turn into civic austerity. If this analysis opened your eyes, subscribe now, because the CMBS wipeout is not a headline, it is a process, and the process is accelerating. In the next video, the spotlight goes inside special servicing to show exactly how one missed payment becomes a foreclosure timeline, and how that timeline becomes a bond loss that hits your local bank. Comment below with one detail. How much of your local economy depends on office space, and what happens to your city when that tax base drops? The pattern completes itself, every time, without exception.